Trivariate's Adam Parker says there's a frothy cocktail that could move markets higher. He actually throws out a bull case on the S&P 500 of 6,500 to 7,000 within the next 6 to 9 months, which for context would be anywhere from 12% to 20% higher from here. But first, before we get into that clip, which I think is very insightful, Adam Parker, he runs a momentum fund, so he tries to go where momentum is. I do want to share a little bit more perspective into the video that I put out last night, where essentially I've flipped. And now I think there's different kind of periods in time in which I'm really referencing. So in terms of a longer term downtrend, I don't think that's going to happen. The 1 to 3 year time frame, I have to be bullish on. There's just too much going for us. But within the next 3 to 6 months, I do think you will get at least one correction during that time. I think there will be a growth scare at some point, but I think this will be a buyable correction, whereas before, I was a little hesitant to even buy a correction because of where markets are and the prospects of a recession. I still think the odds of a recession are higher than 0% as the markets are pricing in, but again, markets are pricing in a recession in areas that they think will be recession vulnerable, cyclical, small caps, right? These areas, they are not pricing in good news. Whereas on the other hand, big tech, which is seen as not recession vulnerable, is doing well, and to a certain extent that is true, with a slight slowdown, not necessarily recessionary, not like an '08 scenario. Big tech should be able to grow their earnings. Big tech should not be super affected by a slower growth environment. So that makes sense why the markets are priced the way they are. And really over the past 25 years, we have not just simply slowed into a recession. Now, is that possible? Could this time be different? Yes, but if we do not see a centralized catalyst to give us a recession, then the odds of a recession are going to drop quite a bit. Now, again, it's still possible we walk into a recession. That has happened before in the history of the US economy. And when you get big boom cycles, you tend to get big bust cycles as well. I've generally held the standard of economic principles here on this channel, but I also don't think this time is like any other period in history. I think there's a new economy that we have inherited via all the government spending we had. Over $4 trillion of basically free money was handed out. And I don't think the markets can really be seen or even valued in the same traditional ways that we have for 100 years. I don't think P multiples are going to be the same. I don't think certain areas are going to be the same. I don't think just shorting a stock because it's doing well is going to work the same as it has before in the past. Because of the rise of retail traders, because of just more people in markets, more money in markets, more passive investing in markets, everything has essentially changed from even 2019, from early 2020. So I want to be clear, I'm still worried and or defensive from now until really April of 2025. If we can get through March's economic data, which we'll get in April, and things are still doing okay, things are still doing fine, then I will grow a lot more bullish on this market. The problem I see is, in the near term, markets could rally to 630, 620 on the SPY, and then if we get a pullback, you may just come right back down to levels we're at today, right? I think if we rally, the pullback could start from a higher level. And from that perspective, do I want to be all in this market? No. Do I think there's good value in some areas of this market? And really, until you see AI fall out of bed and AI become unloved and we get a slowdown in AI, I really don't see big tech rolling over in any kind of big way, which means the markets are probably not going to roll over in any kind of big way either. So yes, our correction's going to happen, of course. Is that a buyable correction? At this point, yes. If we look like we're heading into a recession, then that would be a different story. But at this point, I mean, at least from now until the end of this year, it's probably not going to look like that. From the start of 2025, I think we could get a little bit more growth scares, but that's just a thought. So yes, I do think you want to have more cash on the sidelines. I don't think buying Nvidia here or big tech really makes sense because they're already pricing in really good, outcomes. Buying some of those cyclicals makes sense to me. Playing for the broader market rally, buying small caps, that makes sense to me right now. And honestly, at this point, we have to face the fact valuations really don't matter. Markets have done so well. Passive money will keep flowing into markets as long as there's not something to be super fearful about. Valuations don't matter. Valuations are not in the algorithms to sell stocks when you get to a certain valuation. You're trading at almost 22 times next year's earnings. I mean, it's just not in the model to sell stocks when you get above a 20 or 22 times PE multiple. It's just not existent. People don't care. It's like if there's 50 people in a grocery store with $100 a piece and there's one loaf of bread. I think that's a great analogy. People are going to be willing to pay a lot more for that loaf of bread. You have more money out there and the same assets. Generally speaking, there hasn't been that many new IPOs. It's not like the market's being flooded by IPOs these days. More money, same assets, dictates higher prices. Now, eventually valuations will matter when we do have a recessionary-like environment, but I don't know when that's going to be. I don't know if that's going to happen. Sure, you want to be defensive for that. You want to have cash ready on the sidelines, but when does that happen? Couldn't tell you. So long story short, you do want to be ready in the near term for a correction, but I think that's probably all it's going to be unless it looks like we're actually going to go into a recession, which will take some time to play out. Now, take a listen to this clip from Adam Parker on CNBC.
Let's take us to our talk of the tape, the remarkable run for stocks. Let's welcome our panel. Adam Parker, Trivariate's founder and CEO, also a CNBC contributor. Ellen Zentner is with Morgan Stanley Wealth Management. Both, as you see, are here at Post 9. Welcome back.
Great to be here.
Everybody here. I think the thing that stuck out to me, Elle, about your notes today is you suggest the stock market is extraordinarily overbought.
Yeah. Well,
Why?
I think when you think about where earnings expectations are, let's say we end the year at 240 and the market's looking for 280 at the end of next year. I mean, is that really achievable? And when you look at, volatility versus equity risk premium and sort of what's going to happen after the election and the uncertainty there, it just feels like expectations are a bit too lofty.
Adam, you sort of sit back and you're like, okay, the economy's good, labor market's all right, retail sales tell you the consumer's still hanging in there,
Yep.
Earnings are good, and I'm going to get rate cuts on top of that ice cream. Well, that's a sundae that looks pretty tasty.
Yeah.
Is that correct?
Yeah, I mean, first of all, I love being with Ellen. We sat next to each other for
The
years.
band is back
My
together.
favorite economist of all time. So it's great to be here in person. Look, let's
Glad we could make this reunion.
yeah, it's
happen.
it's lovely. It's wonderful.
You want to talk to markets? You want to reminisce
I
about
just-
the old days?
Listen, you got to take
Good old
it's a
days.
human. It's a human world we're in.
Okay.
All right. In terms of like the bull case, let's get frothed up for a minute. Let's all right, we were 15% higher in a year. What happened? Yeah, I think the Fed just started cutting, and we're probably not halfway done. I mean, Ellen's definitely the expert on that, but I don't think we're halfway done yet, so it would be early to fade that. Maybe they flash a little more to you on China stimulus, and you could argue about whether it matters or not, but the market probably likes it if they give you more optimism there. I think for most companies, the average company gross margins can still go up. I mean, we're going to really stare at that in the next 2 weeks during earnings season, but I don't think input costs are rising. So I got the Fed cutting, I got China stimulating, I got gross margins going up. I think we have a positive skew on what we're going to get out of AI. If you look at, obviously NVIDIA comes in town, it tells everyone it's fine, and ASML missed because it's Samsung, but then Taiwan Semi said it's fine again. But I think ultimately you're going to get some real companies telling you they're benefiting on the cost side from AI, and that's a big leg up if we get that. And we're going to run at a huge deficit no matter who wins, and it looks to me so far like when we run at a big deficit, some of that money makes it to the biggest 20 U.S. equity. So there's a frothy cocktail that could get us much higher. I think Ellen's right. Probably the numbers are a little too high for next year, but as long as people don't get a growth scare on that path, and you dream they're higher in 26 than 25 and that whole thing, you could end up with a 7,000 number without it being that big of a problem in 6 months or 9 months or whatever. I mean, it's not in the distribution of outcomes. It's possible.
But at least a growth scare could be on the horizon. I mean, there is this really big uncertainty around the election out there.
Oh, for sure.
And you get an outcome that takes quite some time. If you get some civil unrest that comes with the outcomes, right? We're just now seeing companies start to really show concerns over how trade could pan out. You've got households are not going to go out to eat. They're not going to consume services if there is uncertainty and unrest in the economy. So you could at least have some near-term hiccups here. And that's where the fundamentals are.
Yeah, I was going bull case, not base case. But I was saying you could get a frothy bull case like ours. I'm not saying.
But yours sounded like a base case.
Thank you. I'm a compelling communicator.
But what was so bull case?
Well, I mean,
did you just state the obvious of what actually the environment is?
I think there's the big controversies from PMs are like, will we get return on the hyperscale investments? And not everyone thinks that we're going to get the AI proof points. I'm not sure everyone agrees that China will be like stimulative if it matters. I think the election is an uncertainty. I don't know what the answer is going to be, but I think the base case is the economy slowing a little bit, but not enough to freak people out. Most people took their recession probabilities down. I mean,
Atlanta Fed GDP is like at 3.4.
Yeah.
So
right.
Yeah. So
there's
earnings,
no discernible slowing in the economy, and with the Fed starting at 50 basis points, I think the soft landing scenario has an even greater probability. I wouldn't even talk about putting a probability on recession. I would put a probability on soft landing just because that's the more optimistic take of it, right? The probability of a soft landing is very, very high.
The market's going higher is the base case. I think the big upside, which could happen, like you want to get crazy, like maybe, Ellen and I wrote a note together. I don't remember if it was 2013 or not.
If you didn't bring it up, I was going to. It was 2014.
But we wrote a note in 2014 saying, hey, what's going to happen, year 2020 or 3,000 in the S&P. And people thought it was crazy bullish when we wrote it together at the time. And I kind of feel like it's the same a little bit scenario now of like, what do we get, 2030 or 10,000? Like
when we hit 3,000? It was December of 2019.
Man,
it was 1 month earlier than you predicted, Adam. What is wrong?
So exactly to really both their points, I don't think it's early enough to throw in the towel and capitulate like Wall Street has and says, we're going to have a soft landing. Things, are going to be fine. We're not going to get a recession. You still need to be weary of these things. And especially as more people are getting more bullish and more bullish and more bullish, like nobody's in the bear camp right now, right? Nobody's a bear. There's like two people that are actually bears out there. And maybe the bears will be right. Maybe the consensus, well past consensus view of the bulls will be right. But either way, I think it's too early to know for sure what the economy is going to do. Historical precedents would say we don't usually just walk into a recession. If we do, there's going to be a lot of money printing done. There's going to be a lot of recovery efforts done. Like the Fed's not just going to sit back and watch us go into a recession, right? So that will offset some of the weakness from an actual recession. It feels like clearly people don't want markets to fall, and it is going to be difficult to get a large pullback. Besides 2022, because valuations companies had gotten, there was a bull market everywhere, essentially. And the Fed and inflation was out of control. The Fed had to raise rates at the fastest pace we've seen in a long time. Like that caused a prolonged period of weakness in markets. But do you really get that on the opposite end? Look how fast the COVID pandemic played out. It was basically straight down and straight up. 2008 would have played out a lot faster as well if they had acted more aggressively. They did not, and that's why they acted so aggressively during the Rona. They will act aggressively again if we do go into a recession. Now, yes, the similarities are very similar from 2007 and today. That's very true. But I do think the overall dynamics are much different today compared to 2007 or 2008. The companies are different in our markets. The amount of people investing in our markets is different. AI is clearly different now compared to what it was then. And the attitude of the Fed is much different. So many things have changed. I don't think we can expect the same typical recession playbook if that is what we do go into as well. Now, would there be downside in the markets? Of course there would be. But is that the most likely case at this point? It's hard to say that with any degree of confidence. And let's face it, the consumer has been stretched in a bad place for a while. And the S&P has continued to put up good enough earnings. Unless there's a bigger problem with big tech companies that drive most of a good chunk of the earnings company for company in the S&P, then it's hard to see earnings declining in any kind of meaningful way even next year if we did walk into a recession. And trust me, I don't want to say I hope we get a recession because that's bad for people, but I hope there is a crash in markets. Like that would be great. I would love to buy stocks at cheaper prices. But I think there is opportunity in certain areas, again, cyclicals, small caps, value stocks. Longer term, I think there will be opportunity in some of your big tech names. But if you're buying those, you really want to have a 10-year outlook for those companies. Don't get me wrong, I still have like 30% of my portfolio in cash, but the areas that I do want to be allocated to are the ones that will benefit if my previous predictions are wrong. And if we do have a soft landing, cyclicals and value and small caps, they're going to well outperform the S&P 500. And you're going to make up the return there, still having a large chunk of your portfolio in cash. So I still think you want to raise as much cash as possible. Still think there will be a better buying opportunity at some point. But if you're wrong, you want to also position for that scenario as well. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys stay safe out there, and I will see you in the next one.